Welcome to Views from the North, a Canadian rates and macro podcast. This week, I'm joined by Adam Whitlam from our Canadian Rates Sales Desk. This week's episode is titled, The Squeeze. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Adam, welcome back. It's your great manyth episode, so let's not count, because that'll just make me feel like I've done this too many times.
It makes me feel like I've worked here for so long.
Well, both of us have, so it's okay. It's been a very interesting week. Lots of high-level data that has moved the market pretty substantially, and lots of current events, I guess, financial market events that are also pushing things. Let's start in Canada, because I think that's what's most pertinent for most of us. We got CPI this week. We'll get GDP on Friday. And CPI came in hot.
Yes.
From every perspective. In fact, I can't think of any perspective in which it didn't come in hot. The core is at 0.3 across the board, ex-food and energy up 0.4. The year-over-years all went higher. All of that was worse than expected. And in turn, rate cut expectations for July have plummeted. We were around kind of 50+% for July, and now we're more like 25 to 35%. So things have changed substantially. In your mind, is this single higher print, and I'm kind of giving away my bias by asking the question this way, but in your mind, is this one higher CPI print a game changer or merely a speed bump, diversion, volatility on the road back to 2% eventually?
Well, as much as I love a good, lively debate, and I'd love the opportunity to come and say, you know, the market is different now. This is going to completely change the metrics for the Bank of Canada. I just can't say that. I mean, I think, to put on my former Governor Polaw's hat for a moment, CPI is kind of like turning a very large ship. It takes a while. It can head in the right direction. You might need to make a small course adjustment along the way as you go. But at the end of the day, you know, when you have we didn't have a print above 0.1 for the first 4 months of the year.
The average was 0.1.
The average is 0.1, which is very low, and obviously would give the Bank of Canada lots of confidence, and did give them lots of confidence for their first cut. To see some sort of give back on that front or some sort of rebound makes sense. I mean, we look for that too when we look at things like job numbers. I mean, put it in perspective that way. If you were to get negative job prints for 4 months in a row, and then you got a big job print to the other side, it wouldn't be overly shocking. So there probably is some give back. Maybe one item that is kind of worth noting is the strength across the board. But again, you can also probably say maybe there's some seasonal adjustment issues. When you have strength in that many categories, it sort of suggests that, okay, well, maybe there was something funky in the data as we look at this on a comparison basis. It's unusual for it to be all the way across the board. But that said, I think inflation is kind of continuing to trend in the direction. And if you're the Bank of Canada as well, you've reiterated that you want this to be kind of a gradual process in terms of cutting rates. And so, should July have been 60% priced after the last cut? I don't think so. And I think anybody who reads what I write or who reads what our desk writes, we tended to agree that at 60%, you're probably a little overreactionary. Back-to-back cuts are not necessarily in the cards for a central bank that wants to move gradually and is also, despite their best efforts to push us away from the U.S., is still looking at our largest trade partner to the south. And they're still cognizant of what's going on in that economy. So, 60%, was that the right level? Probably not. Is 30% the right level? Probably not. It's probably something in the middle there, but in typical Canada fashion, we're either all in or we're all out. And that's exactly what you've seen in the last week and a half or 2 weeks in the rates market is you get these data prints and you get extreme volatility. You get CTAs in selling the market very aggressively and Right now we've been kind of going through a little bit of a transformation where, some of the maybe faster transactional accounts or weaker hands that bought the last rate cut are really getting squeezed. And some of them have said, that's it, I'm out, I can't take it anymore. The great steepener, which worked brilliantly for a couple days after the first cut, all of a sudden, 2s, 5s were back to where we were before the Bank of Canada cut. So some of these trades that got put on late in the cycle are being unwound, and that's why you're seeing some of these extreme moves the other direction.
So on the CPI, I'm not sure, but I'm one of the nerdy people that looks at all the details. It was soft. That I wouldn't blame it on seasonality or anything like that. Personally, it was weak consistently before the prior 4 months. So you do get some reversion to the mean. That is something that is real. But I think that they at the June meeting and the press conference, there probably a little bit too much emphasis on the dovishness that Whitlam displayed. He was definitely more dovish. He did open the door to July, but it was always contingent on inflation continuing to print lower or improve to some extent. And so we had 2 inflation prints. And so pricing more than 50-50 when you have 2 data points and one of the 2 can easily disappoint. Again, 60%, I agree, just didn't make any sense. 30% now, I don't mind. I think that's, in my mind, where we are. What you'd need at this point to get a cut in July would be probably something that looks like, I would guess, zeros on the month over month for the cores. That on its own might be enough, assuming the other data aren't crazy strong. Or if you got 0.1s on the cores and then weakness in most of the other numbers. So get GDP on Friday, touched on that in a second. Jobs next week, and the unemployment rate probably almost certainly goes up. We'll see. You never know with Canada, but I think it was 6.238. That was the 6.2%. So it ain't going to take much to get it up to 6.3. And so you're probably going to have some softness there, but unless you get both of those numbers coming in weak with the 0.1, I think it's hard for the bank to justify another cut when you had that kind of non-trivial speed bump on the CPI front. And especially if you think that Aussie had something similar, though I can make a different case there as well if you want me to. And the U.S. is still a ways away from cutting. And if the economy isn't in terrible shape and the U.S. isn't cutting yet, and inflation's still kind of a non-certainty that it's coming down, then maybe it pays to be gradual, as you mentioned, and the word that they like to use. So that's how I'm thinking about it here. I'm always contingent on the data. When the data change, my mind changes. But for now, it makes, I think, good sense. Our call's been consistently June septies for cuts, and I think we're in pretty good shape here. The chance with the odds were, if we got the low CPIs, we'd have to pull September into July, but that doesn't seem like it's going to be the case. And so things are looking pretty good for the BMO right now.
It's the same. It's the instant gratification thing that we've talked about. You've had other guests on this podcast talking about the same thing. It's the same. It's the exact same issue. The minute the first cut, comes into June, it's like, well, now we have to cut every single meeting, and it's like, no, your central banker said that he wants to be gradual. Cutting meeting after meeting and back-to-back meetings isn't. That's not normal. He'd have
to be forced to do it.
Right.
And the bar is high for them to keep doing that, because getting consistently low inflation prints after having really high inflation prints for 2 to 3 years is not easy, I don't think. We haven't really been here before, so I'm not sure I can make a real judgment there either way, but I would say that there's volatility in the numbers. And so for them to come in at 0 or 0.1 or 0.2 every single month without any outliers on the high side seems like a pretty low odds.
Historically, cutting too fast after a high inflation cycle has resulted in some really bad results. So I'd probably want to err on the side of being more gradual.
And so do they. They don't want that's the mistake they don't want to make. So at this point, it does look like things are going to go gradually, slowly. And with respect to the GDP numbers on Friday, we get the April GDP report and the May flash estimate. April, we're above the flash, so we have a 0.4. We'll see if that's right or not, but either way, if it's on the flash and it's 0.3 and May comes in at a small positive, which it looks like, and that'll probably be helped a bit by the Trans Mountain pipeline coming online, that sets up Q2 for better growth than we thought for sure. We're at 1.5% right now. The bank's at 1.5%, and that could have a 2 handle. Somewhere around 2 is where it looks like it would be tracking with a 0.3, 0.4 for April and a 0.1 for May, with a little bit of upside risk still from there probably. And if that's the case, again, like you'd need really weak CPI to prompt the bank to be cutting with the growth backdrop. That's not all that bad. And don't get me wrong, like Canada's been weak for so long and this might just be a blip. It probably is, but do you know that for certain? No. And if you don't know it for sure, then it probably pays to wait, especially when everybody else is waiting. So again, scales tilted toward waiting a little bit longer, being gradual, being deliberate with this, making sure you don't make a mistake. And that is something I think the bank really wants to make sure that they don't pull off a policy error here and get blamed for more inflation and all sorts of other wonderful things like higher house prices and you name it. Let's get to the market for a second. So what we've seen the past, couple of days, and today in particular, it is currently Wednesday, June 26th at 4:30. Market got pretty hammered today. It got crushed right across. And it started with, yesterday's Canada CPI, a little bit of that, and then Aussie CPI overnight, and rumors about the Bank of Japan being forced to hike rates, and as the yen is getting absolutely annihilated, being at levels we haven't seen in, almost my lifetime, not quite. So since the mid 80s. That there has to be some reverberations from all of this. Walk us through your thoughts there, because you had some interesting ones we went through earlier.
Yeah, it certainly has been a very active rest of June. We won't delve too much into sort of the beginning of June, but we all know, the most broadcast extension ever. If you look at CanDeal trading volume statistics, it was actually the busiest June one of all time in terms of CanDeal volumes. Now, obviously, there's some natural growth there, but just in terms of bond issuance and supply.
You mean there's a lot of bonds out there?
Yeah, apparently there's a lot of bonds out there. And you had an absolutely textbook market condition where you had power flattening into the curve. You had a lot of interest from accounts coming out of that, active type managers to put on steepeners to fade 10s, 30s. So what we're seeing now is it's almost like the bounce back from that. The 10s 30s curve has been flattening very aggressively. There's there are a number of very large active accounts who took views on a steeper 10s 30s curve, which makes sense for lots of different reasons. A lot of the forced index buying, which started June 1 and again on June 15 and again on June 18, is now out of the way. And the normal course provincial issuers are kind of out there in the market, and there's reverberations going on through Japan about defending the currency, and if they need to defend the currency, they're going to have to sell treasuries, and that's also going to steepen the curve in the US and steepen the curve in Canada. So there's been lots of iterations, and the Bank of Canada cutting rates. There's been lots of reasons why the great trade of 2024, the steepener, it was time. And what we've been seeing in the last week is the complete opposite. The curve has moved dramatically flatter. We've seen a broad sell-off in yields in general. We've seen 10s, 30s, that trade has moved considerably flatter. There's been a number of stop-outs going through by accounts that had it on that have been positioned the wrong way. So I think you're seeing a little bit of a risk transfer from what I'm going to call more actively managed accounts into more passive accounts. And these actively managed accounts are stopping out of some of these poor positions. And it's not like we're not finding liquidity or the dealer market is getting long on the back of it and feeling all the pain. We are finding plenty of trade on the other side. And so I think you're just seeing a washout of weak hands to strong hands. And so, you will see, this will clear, and this flattening of the curve, I do think you're going to get a re-steepening once this maneuvers into hands that are, more willing to hold on to these trades. But for now, it's just a path of pain.
Yeah, and I'm going to guess that the summer months get a little bit quieter. Assuming they do, we probably just grind steeper. Mm-hmm. Just like a little bit at a time. Supply won't be quite as strong, but I just have trouble believing there's demand for the long end at these levels on rate. It just doesn't make sense to me.
Yeah, I tend to agree too. Like looking at sort of Canada in relation to the 10-year part of the curve, outright yields, yes, absolutely. If you are out there looking to sort of buy outright yields, I think you're still shopping around and you're still happy to add on each sell-off. But in terms of curve, in terms of box versus the US, I think some of those trades will start to pay off. 2s, 10s, 2s, 5s. There's other areas like I think the front end of Canada, which was overloved. has underperformed pretty dramatically. And that's why you've seen kind of some more of that flattening going on in the front end.
10s have gotten crushed cross market. 10 beeps and
absolutely.
Not a lot of days.
Yeah, absolutely. A huge move. And so I think these things are going to recover, but right now you're just getting a bit of a washout. And on top of that, it's kind of worth noting because we've seen some kind of interesting flows. It's obviously it's not a bank quarter end, but it is a quarter end. And so from some of the international accounts, we have seen some pretty big international type rebalancing. Some of that stuff has been, and I'll bring this up later when we're talking about trades and stuff like that, but some of the stuff has been in the international markets, like US dollar provincial bonds have been very active. We've had a couple of the most active days we've ever had, and a lot of that has been position squaring. And again, it's dislocating the market. So some of this stuff is getting very, very cheap versus where domestics are. That too, I think, will pass. One of the biggest questions that I've been asked by, I would say, every single account, even ones that aren't even involved in the space, is swap spreads. What is going on there? When will they stop dropping like a stone?
When does the hurting end?
When does the pain end? There's been lots, and when we talk about squeezes and stop outs, there's another trade. There's been lots of long swap spread positions that have just been annihilated. And, I think it's worth noting, we were talking to an account about this actually earlier today, where headline spreads, just given the inversion on the curve, there's a natural bias on headline spreads. Per month, they get worse by about a basis point if nothing changes on headline spreads. So there is this natural lower bias on the headline. If you look at the match maturities, don't get me wrong, they're still lower because spreads are still moving lower, but they have outperformed in some respects. So on the match maturities, or even your rolled down headline spreads, yes, you've lost money. You haven't lost as much money as it would appear you have when you look at your 5-year headline. But yeah, lots of questions there too. And I think we're also seeing a washout in swap spreads.
Almost like the warning that Fred Nastos had on this show about a year plus ago about more Canada bonds, meaning sharply lower swap spreads.
Yeah, when we're talking about the CMBs.
Seems to be coming true.
Yeah, it does.
Almost like more bonds does have consequences. Issuance has consequences. We don't really believe that there's consequences in the world. We like to protect everybody from all consequences out there. But in this case, there's no protecting people from falling swap spreads. And I don't know why this ends.
Like the net issuance, though, like to your point, like we talked about like a year ago in terms of the debt management strategy, the net issuance wasn't all that high. It was actually probably less than we were really expecting. But I think you combine it with provincial issuance has been absolutely astounding, internationally and domestic. I mean, they are so far ahead of their issuance programs. So I think, even though the federal government bond issuance might not have been as high as was expected, the provincials have more than soaked that up. Combine that with sort of other issuers, there's just more stuff out there.
And I wouldn't necessarily say relative to very recent expectations. I'd just be like relative to the past 10 years.
Yeah.
Where Canada would always trade rich on asset swap and now not so much. Yep. We're converging with the U.S. I don't think we get to the U.S. levels, but directionally similar, if nothing else.
Yeah, I'd have to agree with that. I mean, the U.S. is a whole different ball game. They've got, it doesn't really matter who gets elected there in November. There is an enormous amount of issuance that's going to continue to come out of the U.S. I'm not going to say they're in that sort of debt spiral, but it does seem to be approaching those levels where, I just don't think they have a political environment where anyone will step in to say it's time for some fiscal restraint.
The day will come. It ain't today, but it's going to come eventually.
I think it'll be a reckoning, not a day. But.
Yeah, fair enough. I would just bet the market forces that to happen, but I kind of hope not, because when it does, it's going to be pain right across the board. I think for everybody, everywhere, for any asset holder, I think any kind really. It will be a reckoning that will not be enjoyable at all. Let's move on to trade ideas then. I continue to like the cross market steepener being long U.S. 10s versus Canada longs, and kind of there's a few different parts to that. One, Canada is rich on a relative basis. Cross market curve is too flat. All that as we talked about. So instead of just being short 10s 30s, instead of steepening 10s 30s in Canada, I think you also can do it against the U.S. and you take advantage of that cross market richness as well. And I think the divergence between Canada and the U.S. probably got a little bit overplayed in everybody's mind, and Whitlam didn't really help in that way when he's like, we're not even close to the maximum divergence that we can get on policy rates. But the reality is that, like, from a macro perspective, so like take out all the words, take out all the talking heads, including the central bankers. And like from a macro perspective, is Canada and the US, are they really going to diverge that much on the growth and inflation front? And we've seen a pretty big move over the past year, and a lot of that's mortgage driven. And like, is it going to get worse than that? That seems like a bit of a stretch to me. And you saw the softer U.S. retail sales numbers. Looks as though U.S. growth is decelerating at this point in time. It's not falling off a cliff, but it definitely decelerating. And then you have on the Canada side, again, the higher inflation numbers. Like, we're not going to consistently be one way either. And so that just reminds me at least that divergence may not be quite as extreme for quite as long, which makes me a little bit more comfortable with that trade now than I was. And the reason it's U.S. 10s instead of U.S. longs is, one, I like the curve steeper generally because rate cuts are coming, whether it's now or later. They're coming this year, I think. But also, you don't want to be long the U.S. long end. I just those are not bonds you want to own. Between the fiscal side of things that we discussed for a second here, and like the reckoning will come eventually. When, I don't know. And U.S. inflation is higher, so you could see more premium built in there. It's just not a place I think you want to be. You're much better off owning the 10-year space where you will at least get the benefit of Fed cuts when they come.
And you basically take a negative carry trade in Canada and you build it into a positive carry trade. So I'm on board with that trade too.
Hop on the wagon. The more the merrier. What else? What do you got? What else do you have?
So I'll go a little more esoteric. I was kind of alluding to it earlier, but some of these US dollar provincials, I think the funding from the provincial side in international markets, as I was mentioning earlier, has been absolutely astounding. We're well north of where we've been for the last all time ever in terms of where we are in the year and just the absolute amount of international funding that's been done. I know other guests of yours have, like Joel, for instance, has alluded to, this has really pushed up some of the cross currency basis curves, most notably currently around in the 10-year space. So, there are forward structures in Cora SOFR that you can put on. Again, that's kind of more geared toward your active management, fast money type account. But another way to take advantage of it, if you're a real money asset manager, is with what's been going on the end of this quarter and central banks realigning and taking some sales on some of their long positions in these various provincial deals. You can do things like buy. We did this trade earlier this week. You can buy an Alberta 6-year dollar bond, swap back to Cora at 10 back of where you can do it domestically. You have the exact same credit. You can swap back the flows to be the exact same exposure. You still own Alberta bonds and you're owning them at an additional 10 basis points. And it's not like you give that up on the funding side. They fund at a spread which is very comparable versus SOFR to where they would fund here versus Cora. So why not take 10 free basis points? Another example of that would be like the Government of Canada bonds. Those are extremely cheap. US dollar Government of Canada bonds, there's a great way to own, if you're looking at Canada bonds and saying, you know what, I don't mind owning a Canada SEP 29 at Cora +5, you can own it's a 2028 US dollar Canada bond at quite a bit more than that. So you get the same exposure and is there less liquidity? Yes, but you get compensated for that liquidity really quickly. Like if you say an Alberta 6-year bond here trades a half a basis point wide, in the US, maybe it trades 1 to 1.5. That 1 to 1.5, when you're carrying 10 extra basis points versus swaps, you make that back quickly. So you get these opportunities where a flow like this flow with central banks puts these things out of whack, and you combine that with the fact that 10-year basis is extremely high, so you want to be hitting the bid on that. And in 10-year, that's kind of the highest part of the curve. So if you can buy some Ontario $34 paper at 10 back of Ontario 34s here, that looks pretty good. If you're more domestically focused, the asset swap roll down curve looks kind of very attractive. In the 2031, 2032 part of the curve, we've actually been lifted on a few $100 million of that stuff this week alone for exactly that reason. You're talking about sort of 4.5, 5 basis points of asset swap compression as you roll down that curve, which is one of the steeper parts of the curve. So I like that stuff. All looks pretty good. So yeah, I'll stick to credit.
Target rich market, it sounds like.
Right.
Lots of opportunity.
Although, ironically enough, one of the reasons that this stuff is being sold, and I think there is a preface to this, swap spreads look great. G spreads look less great. And that's just a symptom of, with what's happening in asset swaps. And so maybe another part of that, although I like the provincials, I like them relative to, domestic provincials. I like the Canada bonds. Maybe it's worth saying, you know what, I'm going to take a long position in swap spreads here, and I'm going to wait for G spreads to widen out to convert that into a credit position. I do find it a little hard to get excited about CMB 5 years at 19 3/4 back of Canada's. That's tough to like.
5-year credit is quite tight, and asset swap buying is what's driving that. And I mean, I guess the question is whether that reverses. Like if swap spreads don't push back higher, does the buying just continue, or is there when does that end?
That will just be a cushion. It will end up being, fortunately, I guess the credit component, if swap spreads continue their decline, is going to act as a cushion on the way down. But also, if swap spreads do bottom out, and I do think, from what I've heard, there is a little bit more mortgage fixing going on a little further out the curve, from what I've heard, which I think is notable because, the big trend from that community has been pay 3s, receive 5s. And if anyone who's looked at a mortgage market... So me, anyone who's looked at a mortgage market can tell that, 2s, 3s in the Canadian mortgage market is inverted by almost 100 basis points, and 3s, 5s is inverted by about 11. So
let me think.
Right. So there is very clearly a bias toward 3s, and that's kind of precipitated this 3s, 5s flow. But as rates, were cut and have fallen, from what I've heard, there is some more fixing starting to happen in that 5-year part of the curve, which would be supportive and would reverse that flow, and that might suggest we're closer to a bottom than a top on swap spreads.
I'll believe that when I see it. I'm not so sure that people are going to be rushing to lock in 5-year mortgages unless we get a further reduction in rates from here. I think the level matters, and the level's still too high, and then unless that curve is super inverted, 11 basis points would not get me overly excited. I'd rather pay the 11 away, but maybe people are just taking the lowest rate they can get, and maybe that's 5 years, and maybe you're seeing that. It hasn't quite shown up in the data, so your evidence here, I'm assuming, is anecdotal. But we'll see in the mortgage flows. They come a couple months. Takes a couple months for them to come out. We'll see how that unfolds. For now, it's still the biggest movers, or the biggest take up is in 3 to 5 year. Still, that hasn't changed. So sub 5 year, but north of 3. We'll see. Something to think about. Something to watch for. Adam, thanks for coming. This will be the last episode for a couple of weeks since I'm going on vacation.
Yes, you are. Have a great, well-earned vacation. Drink some wine.
We know I'll do that. And then probably do a couple around the bank and the Bank of Canada meeting in July. And then I'll probably take August off for podcasting because it gets pretty quiet. When Canada gets quiet, there's just no need for podcasting. So I hope everybody has a good few weeks, and hope to have a new episode for you toward the end of July. Adam, thanks again.
Thanks for having me.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.